One of the most important things you can do as a real estate professional is stay informed on where things stand in the market. We're here to keep you up to date on some key metrics on an ongoing basis to make sure that you and your clients have the bottom line. Good morning. Today we'll talk about some of the key metrics that you want to remain familiar with in an ongoing fashion in order to stay informed on where things stand in the market. We'll cover where things stand as of today and the frequency in which you can expect to hear additional updates on some of these key pieces of information like mortgage interest rates, home values, and inventory levels. We're here to be a reliable source of relevant information so that you can stay informed on the constantly changing real estate market conditions. We're going to keep you informed with news and updates, but also some consistent staples, pieces of data that we get released on a weekly and monthly basis you can have access to and have a pulse on what's going on in the market. So let's jump into some of those staples. One that we're always going to bring to you on a weekly basis is where are mortgage interest rates. So again, we pull this information from the Mortgage Bankers Association to get an average across the industry on a 30-year fixed rate mortgage. We see interest rates pretty similar to where they were last week at an average of 5.47% currently. Another thing that we'll have for you on a weekly basis is application volume. So these are mortgage applications for a home purchase, new applications started, and a weekly update on where things stand compared to last week and also year over year. So what we saw for purchase applications was a decline of 1.4% week over week. That puts us down 19% year over year. So we're still seeing the impact of higher interest rates dampen the buyer side demand and have a difference from where we were last year. Another thing we'll be bringing to you that we mentioned in a previous video is pending home sales. So this measures signed contracts as reflected in the MLS and reported by the National Association of Realtors. It's available on a monthly basis. The most recent data we have currently is for the month of June. And in that month, we saw a drop of 8.6% month over month. And that reflects a drop of 20% year over year from 2021. A similar data point is going to be existing home sales. We'll have this on a monthly basis as well. This measures closed mortgages as reported by the National Association of Realtors. And this is most recently available for the month of June. That was also down 5.4% month over month, which was down 14.2% year over year. So you can see a trend here in these numbers as, of course, they're all related. As far as home values go, the gold standard when it comes to home value appreciation that we pay most attention to is the Case-Shiller Home Price Index. So this is going to measure changes in residential prices on a monthly basis. What we're looking at most recently is for the month of May. Home values month over month were up 1.5%, which puts them up 20.5% year over year. So a really significant rate of appreciation we're still seeing in the marketplace as far as values. And then lastly, a key factor, as we all know, as a real estate professional out there in the market working with clients, is inventory. So total housing inventory we'll also have on a monthly basis for you. This is going to measure the total number of houses available for sale. And we're talking about single family houses here. We're focused on the primary portion of the housing market, which is going to be primary residences. So that total housing inventory in the month of June was 1.2 million. That was up from 1.1 million in the month of May. And that's roughly level with 2021. So we've seen some reduced transaction volume due to a reduction in the buyer side demand with higher interest rates, but inventories are still very low. And that does support the increase in home values that we're continuing to see. When supply is low, that's going to drive prices higher. Now, another key metric right now that has such a big influence is inflation. And we talk about that because it impacts the housing market in a big way. So Jake, tell us, what are we seeing right now with inflation and what do we need to be familiar with when it comes to that topic?
Yeah, that's a great question, Kyle. So why don't we start off with how do we measure inflation? And in this country, we measure inflation through something called the Cpi Report. That stands for Consumer Price Index, and basically it measures the cost increase over time. So where is inflation today? Well, we just got the CPI back for July, and that came in year over year, showing that inflation is currently at 8.5. Now that's down from the peak of 9.1, and it's lower than a lot of industry experts expected it to be, and they were projecting at 8.7. So what does that mean to you and your clients? Well, if we see moderating inflation, that should help drive interest rates down, and that's why we're keeping a close eye on this metric and keeping you informed on it. But let's go back to the first part of the question. Why are mortgage interest rates and inflation even connected in the first place? Typically, inflation leads to higher interest rates because it devalues the US dollar. And when the dollar is devalued, investors require a higher return on those investments that they may make. And that includes investments in the bond market. And that's the primary factor that's going to connect inflation to mortgage rates and driving them higher or lower. In periods of higher inflation, mortgage interest rates tend to rise. That means that taking out a mortgage loan will be more expensive on the interest rate and therefore a higher monthly payment on the loan, and therefore going to have an impact on buyer demand. So what's the bottom line? Well, while no one can predict the future of interest rates with exact certainty, we definitely know that inflation is going to play a really big role in the rest of this year. We now know that mortgage rates and inflation are connected, even though they're indirectly connected, and that if inflation continues to rise, we're going to see higher rates, and if it decreases, we're going to see lower rates. And that's why we feel it's an important metric to continue to monitor on a monthly basis, and we'll be continuing to bring it to you here with the bottom line.
Yeah, thanks, Jake. That's definitely a good point to keep in mind. One topic that's certainly been tossed about quite a bit recently, and each of you watching this video has probably at least been asked once or twice, is are we heading for a housing crash? Are we looking at the kind of situation we were looking at in 2008 when home values dropped really substantially? So that's a big topic. I think there's a lot of little factors currently that are influencing that conversation, right? And we try to approach everything in this series and in the way that we do business with information and data versus speculation. So one factor we can take a look at right now that's critical when you look at whether we're in a housing downturn or what's going to happen next is foreclosure and delinquencies. Looking at loan performance, that's going to give us information on a key part of the housing market and how much strength there is there. So CoreLogic is an organization that provides data on loan performance. In their most recent report, they gave data that shows that in the month of May, overall delinquencies have dropped to a 23-year low, showing a lot of strength when it comes to this sector. Loans that are 30 days or more past due declined from 2.9% to 2.7%. And loans that were considered seriously delinquent declined from 1.4% to 1.3%. Loans in foreclosures, a big one, is going to remain at 0.3%, which is near a multi-decade low. So a lot of strength when you look at loan performance and compare it to historical data points. We're in a very strong position as to how mortgage loans are currently performing, which is going to have a huge influence on the housing market. So that's in line with what we're looking to do here, which is go beyond the headlines, provide you with real data on what's going on in the housing market so that you can answer people's questions, concerned, be well informed, and position yourself as a real estate professional who understands exactly what's going on. We want to make sure you and your clients always have the bottom line. So thank you so much for tuning in, and we'll see you next week.